On behalf of Women and Young Members Excellence Committee of ICAI, welcome you all in the Sky High Symposium Series 55. Sky High Symposium Series is the Wednesday series of programs conducted by Committee for the Women and Young Members. It is one of the Women and Young initiative to not only disseminate the information to members on technical operations and to empower, inspire them to come at forefront and realize their verbal skills at public forum. Today, we are going to cover a session on fraud and investigation in life insurance industry, and the second session on taxation of charitable trust with amendments applicable for assessment year 23-24. For our first sessions, we have CA Hina Bakchandani as our first speaker. Hina is a bachelor in commerce from Mumbai University and she is a chartered accountant from ICAI. Since she believes that learning is an ongoing journey, she has completed a various ongoing diploma and certification courses from ICAI such as DISA, forensic audit, fraud and detection, money laundering, and besides certifications on enterprises risk management from Institute of Risk Management, UK, and CISA from ISACA. Has 2 decades of experience in integrated internal audits, operational risk, and fraud risk management. She specialized in life insurance industry in national and international markets. Currently, she heads internal audit, vigilance, fraud control units, and life insurance company limited. CA Hina, you may please start the session.
Yeah, hello.
Thank you very much.
Thank you, Hina, for being here. And before Hina takes over, let me also welcome everyone. So I'm taking a minute from Hina's time with your permission. So, as a chairperson of Women and Young Members Excellence Committee, friends, I welcome all of you. And first of all, let me welcome Hina Madam, who will be taking us through the fraud investigation in life insurance industry specifically. As such, a fraud is a very big subject, and we thought her experience in insurance sector is excellent. So we have invited her for specifically insurance sector experience in investigations, fraud related matters. And another topic is today is on the charitable trust taxation, the recent amendments which have come through the budgets. So we'll be taking, Michel Bhanushali will be taking us through that. I also welcome all our moderators, Hema, Mayuri, Meghna, and Amrit on this 55th episode of our Sky High Symposium. And I'm very proudly saying that 55th episode because since last 55 Wednesdays, we are sessions, and it is our endeavor to serve the best to our women fraternity. And for the same friends, we are here to serve all of you. And if you have any suggestions relating to any program on women and young members, feel free to reach out to us. We are always there. This is our endeavor, and this is the platform for all of you to come as a speaker, as a moderators, and also as the audience. With these words, I once again welcome all of you, and friends, looking forward. And I'm sure that this session will add a valuable knowledge to all of you. With these words, Hina, I request you to take the session.
Thank you, Preeti ma'am, for this, for giving me this opportunity, and thank you, Hema, for the introduction. And I would also like to thank everyone who has joined us on this call and on this Sky High Symposium. It's indeed a privilege to be part of the 55th sky high symposium, and I hope there are many more to go from here. So the topic for today's discussion is frauds in life insurance industry. I'll just share my screen. Yeah, is the presentation visible?
Yes.
Yeah. This is, as Preeti Madam rightly said, it's a vast topic. And, to cover this topic, maybe a lot of time would be required. I'll briefly touch upon frauds in the industry in this 1 hour session. So, the first thing is, what is fraud? We all are aware of fraud in some form or the other. So much of coverage is there in the media, in newspapers, be it web series or any other place. The topic of fraud is, or the word fraud is known to one and all. So the contents, coming to the fraud definition, a layman's definition is any behavior by which fraud is any behavior by which one person intends to gain a dishonest advantage over the other. As I said, this is a term which is very widely used and commonly used. We have some or the other articles on fraud every now and then covered in the social media, in newspapers, in movies, and now very recently in web series. So I thought, why not connect the definition of fraud to the recent web series? The first one being, where there's a serial killer who, deceives women, and he makes them believe something. He makes them believe a fact which he knows is not true, and then succeeds to kill women, 27 of them. The second example that I can think of is a series where there is a match fixing which happens in almost every match, and there are a group of individuals who wrongfully gain at the cost of other, compromising on the ethics and making money out of fixing matches. So this is any behavior. It's not just fraud, it's not just limited to a corporate, but it's any behavior by which one person intends to gain a dishonest advantage over the other, and it is an intentional act which is committed to secure an unfair or an unlawful gain. The gain can be to one person, it can be for a group of persons, and that gain to one person or group of person is unfair to the society or to the public at large. This is the third example where the person prints fake currency and thereby gains an unfair or an unlawful advantage at the expense of the economy. Moving on to definitions of fraud. So fraud has been defined the first time in India in 1872 under the Indian Contract Act. And it's so beautifully defined that even after 151 years, the definition holds true. Section 17 of the Indian Contract Act defines fraud as fraud means and includes any of the following acts which are committed by any party to the contract or with his connivance or by his agent with the intent to deceive another party. So what is important over here is that the intent has to be there to deceive another party or his agent or to induce him to enter into a contract. Fraud is a suggestion as a fact of which is not true by the one who does not believe it to be true. The person who is trying to deceive the other person knows that, what he is saying is not true. So the intent is there to deceive. There is an active concealment of fact by one having knowledge or belief of the fact. It is a promise which is made where there is no intention to fulfill that promise. There's no intention to perform it. It's any other act which is fitted to deceive or any other act or omission as the law declares it to be fraudulent. So that's the definition which is given by the Indian Contract Act 1872. I have extracted a definition of fraud from the Companies Act 2013, which is more applicable to a company or to a body corporate. Here, the words which are highlighted in red are the ones which are really emphasized upon. So fraud in relation to affairs of a company or a body corporate include any act, omission, concealment of fact, or abuse of a position committed by any person or any other person with the connivance in any manner with the intent to deceive. So if you see, most of it is coming from the Indian Contract Act 1872 to gain undue advantage. Here it adds, because it's a Companies Act, to injure the interest of the company, its shareholders, its creditors, or any other person. Or any other person makes the definition quite broad. So it could even cover employees, it could cover vendors, it could cover any other person, maybe whether or not there is a wrongful gain or there is a wrongful loss. So this is again quite important, where the Companies Act is making it very explicit that even if there is no wrongful gain or wrongful loss to the person who has committed the fraud, as long as there is an intent by the person to deceive another person, so even if there is no wrongful gain or loss, it will still it will still come under the ambit of fraud. Moving on to the next section of my presentation is on what are the conditions which lead to a fraud. Why does a person commit fraud? So this has been in the 1940s. There was a famous criminologist called Donald Cressy. He was trying to analyze the behavior of fraudulent individuals and also trying to think on what makes them actually commit a fraud. What is it that drives them, or what is it that makes them do something which is wrong? And as per the fraud triangle, and he came up with a model which is called the fraud triangle. It's famous and it's widely accepted in all the fraud circles. Now, this fraud model has three components. The first one is pressure. The second one talks about rationalization. And the third one is on opportunity. So this is a model which is widely is being explained by Mr. Donald Tracy as conditions which lead to occupational fraud. What is pressure? And what it says, the model says that when all these three conditions are present, fraud is bound to occur. So the first component of the fraud triangle is on pressure. Why pressure or a motivation? So the model goes on to say that, fraud is committed by human beings. It's committed. So if an individual is under tremendous pressure or stress, for example, he's an employee of a company and he's under a pressure to meet his or her sales targets, or is under pressure to compete with his peers on a professional front. If there is on a personal front, there's someone who is ill at home, or he or she has got a lot of medical expenses to incur. He or she wants to maintain a very lavish and a luxurious lifestyle, which is not possible in his or her current salary. These are all areas and reasons why a person may be under a constant pressure to earn more money and may think of ways and means how he or she can make more money in a lesser point in time. So that's the first component, which is called the pressure or the motivation. The second one is rationalization. So people of these categories tend to rationalize their behavior on why they think it's okay to commit a fraud. For example, maybe one of the disgruntled employee and might feel that, my boss has not given me a good increment or an appraisal. I deserve more. I have worked hard and I have not got the kind of money that I deserve. So it's okay to commit a fraud and, make up the loss. Or if everyone else in the company is doing it, everyone is forging a signature. So even if I do it, it's not a big deal. So this is how they try to rationalize their behavior, that it's okay to do a fraud. It's okay, to steal a little money. Or maybe, I'm doing this because I want to, meet the business targets. It's going to benefit the company. I'm doing this for the top line of the company. and the company owes it to me. I have worked in the company for so many years, so and I've saved so much money for the company, so it's okay if I have saved 100 crores, and if I'm making 2-3 crores of fraud, or I'm taking that money home, it's okay. So this is how they tend to rationalize their behavior. While pressure, these components on pressure and rationalization are dependent on the individuals, and these are uncontrollable, not fully in the control of the company. There is a third component which is called the opportunity, and this is the component which a corporate or a company can control. So what is opportunity? For a person might be under a pressure, he might rationalize his behavior, but he can be successful in committing a fraud only if there is an opportunity to commit a fraud. For example, if it is a business wherein large sums of money is accepted in cash, and the person is in cash handling, he will have the opportunity of doing teaming and lading. He will have that opportunity because he's old in the system. He knows the systems in and out. There is absence of supervisory review. The boss relies on him. So he might feel, okay, there is an opportunity. I will take it today, and I'll take it as a loan and maybe repay it another 5 years and another 5 or 6 days. And this is how the act of fraud starts. So companies have to make an effort to reduce these opportunities. Examples can be, incorporate segregation of duties, have job rotations, often ensure all employees, or at least the critical employees, go on mandatory block leave, so that others can take up at that point in time and can detect if there is anything wrong that is going on, and so on. So the model clearly says that opportunity is something which can be controlled, and this is where we chartered accountants come into play, and we contribute in companies by recommending them opportunities for improvements in their internal controls. So be it internal auditors, be it IFC auditors, internal controls over financial reporting. As finance professionals, this is an area where we all contribute, and thus this topic is relevant for all of us. So when we do internal audits, we do think how is there any opportunity or is there any vulnerability in the system that can be exploited by a fraudster to commit frauds. So as I've mentioned, pressure is financial or emotional pressure, which puts a person and forces him to commit a fraud. Rationalization is personal justification of dishonest actions, and opportunity is the ability to execute the plan without being caught. So we spoke about the definition of fraud and why the fraud happens, what are the reasons why the frauds happen. Now we move on to the main topic of our discussion, which is on frauds in life insurance industry. So I have taken these extracts from newspapers and so on. So there was a very recent Deloitte survey, which was done in very recently, early this year, 2023. And wherein they found out, the research has found out that insurance frauds have costed $6 billion annually. And insurers are losing 10% of their overall premiums. So a survey was rolled out, and the top 3 reasons that were identified for increase in frauds are as follows. The first one is 22% of the people said that, frauds are on a rise because of remote working, or the environment in which we are, where most of us are either working from home or it's a hybrid environment, and payout transactions and many other transactions happen remotely at home, away from the office, away from the webcams and all, gives people an opportunity to commit frauds. 34% of the respondents in the survey said that increased digitization is attributed to higher amount of frauds, while 22% of them said that the internal controls have been quite weakened in this COVID era in the last 2 to 3 years. And these vulnerabilities have been exploited by the fraudsters, and this has resulted in increased frauds in the insurance space. Coming to the types of frauds in life insurance. So broadly, IRDA is a Insurance Regulatory Development Authority of India. They have also defined or classified frauds into these 4 categories. The first one is a policyholder fraud. By policyholder fraud, I mean it is the customer who's buying the policy is actually doing a fraud against the company. We'll talk about it as to how customers do frauds against the company. The second one is internal fraud. Internal frauds are done either by the employees or by the management of the company. The third is intermediary fraud. As everyone is aware, life insurance is primarily sourced by distributors who are advisors, agents, bank partners, and so on. So the third category is intermediaries can also commit a fraud. And the fourth is, as more and more digitization is happening, this is the fourth category which has emerged, which is online frauds. Now, I will, in the interest of time, I have taken a few scenarios of frauds and I will elaborate them with case studies. So the first one, which is quite unique to life insurance industry, is policies being sourced of deceased individuals. I mean by this, the person has already died, and after his death, somebody is buying a policy for him or her. So how does this actually happen? So the first one, the case study is where the salesperson goes and he meets one of the customer. He goes on a sales call. It's a salesperson or an intermediary, an agent, whoever. He gets a call from someone that I want to buy a policy. He goes and meets that customer. And the customer says, I want to buy a policy for my wife. These are her KYC documents. I will pay the premium on her behalf. She is gone out of town. So she will come after a few days. You can leave the proposal form. These are the KYC documents and the premium. After she comes back, I will ask her to sign the form. You can meet her at that point in time and submit the documents to the insurance company. After a few days, the salesperson again calls the customer and asks, has your wife come back? Because as per the insurance rules, I have to meet, as per the company rules, I have to meet your wife. I have to sign the advisor confidentiality report. This is a format of the advisor confidentiality report that he has to, the salesperson or the agent has to say whether he has, how long does he know the person? Is he related to the person? What are the income details and so on? So the salesperson asks the customer, is your wife there? Can I just come and, meet her? Now, customer knows, the customer just makes an excuse and says that, oh, she's still not there. And the salesperson, because he is under pressure to meet his sales targets, the first component of the fraud triangle, he tells the customer, okay, you do one thing, you just sign on behalf of your wife, give me all the documents, and I go and log in the policy. And he goes and fraudulent and wrongly says that, yes, I have known the life assured, I have met her in person, and submits the proposal form with the premium to the insurance company. 6 months later, claim gets reported to the insurance company because it's just been 6 months, it's a red flag. So field investigators are sent. The field investigators go and discuss with the neighbors and, vicinity checks. They go to the medical store, they go here and there and find out. Finally, they go to the office where the death certificates are issued, and they realize that the life assured had actually died 2 years ago. And the information that was given by the proposer in the form was false. So this is one kind of a fraud. And in such situations, the insurance company will reject the claim because the information which has been given by the person is not true. So this is a situation where, it can be classified under a policyholder fraud also, because, the husband was very much knowing that his wife is not there. And it can also be categorized under intermediary fraud because the person who went to buy the policy didn't exercise enough due diligence and just relied on the customer's information. The second case study is where the life assured's documents are not verified against the original. So the examples that I'm kind of giving you all are actually real life examples, and they do happen, and we've seen these happening many a times. For example, it is an insurance company's branch office and someone just walks inside and says that I want to buy a policy for my brother, and my brother is out of town, he's not here, and these are the documents that I have. And constantly there is a pressure on the salespeople to meet their sales targets, and the documents get accepted, the premium is paid. Again, after 6 months or 2 years, when the claim, sometimes the claimants pay premium for 1 or 2 years. So 2 years premium is paid, then a claim gets reported, claim investigation is done. Again, the same thing comes into light that the person had died long ago. So had the sales personnel in this case, had he exercised that due diligence, had he seen that, he would have checked the original documents, he would have checked the photocopies with the original documents, probably this application would not have been accepted. The third is on organized crime rackets. So there are these organized crime rackets in many parts of this country. They are, these negative areas where these rackets operate. What they do is, they will go and approach poor families. They will have a list of people who are deceased and vulnerable families, go and meet their families and tell them that, lure them that, we will give you 50,000 or 1 lakh. You give us the KYC documents of your deceased people. Taking those KYC documents, they go open bank accounts in their names, then buy policies, pay the premium from those accounts, submit the KYC documents and the premium to the insurance company. They paid for 2-3 years, and the crime is so organized and it's done in such a perfect manner that sometimes the fraud is not unearthed by the insurance company, and these criminals sometimes tend to gain because the claims get paid out. And in some situations, if they are caught, then they are taken to the police and a lot of things happen. So this is kind of a third party fraud where there is neither the policyholder who's involved, the families don't even know that, these criminals are going to buy policies for the deceased people. All they know is that they will get 50,000 or 1 lakh if they give the KYC documents. So this is the first category of fraud, which is very prevalent and common, policies of deceased individuals. We move on to the second category. The second category is non-disclosure of material facts. So insurance is based on the principle of utmost good faith. So insurance companies, they will have a proposal form and they believe that whatever, they will go by word of mouth, whatever the proposer or the life assured has mentioned in the proposal form is true and correct. And it is on utmost good faith, they will issue the policy. Later on, if the claim is reported, at that time when the investigation happens and the insurance company comes to know that there were facts which were not disclosed, then depending upon the policy terms and conditions, the claim may or may not be paid. So non-disclosure of material facts could be anything related to habits of a person or, his or her lifestyle, occupation. So I'll just elaborate with a few case studies. The first one is on non-disclosure of habits. Many a times it happens that, people are smoking 8 to 10 cigarettes or 15 cigarettes in a day. There is a question in the proposal form which asks, do you consume tobacco? Are you alcoholic? And, how much do you consume? And people are probably, they are not aware, or, it's their ignorance, or, they feel it's nothing. So they just don't disclose it in the form. And they say that I am just okay. And the policy gets issued. It's not that companies don't want to issue policies to smokers. It's just that they have to disclose that they smoke. So there will be additional premium that will be charged. But these people, either them or the agent or the salesperson, whoever is filling the form, will not disclose the facts or habits of the customer. Then when the claim gets reported, the investigation is done and the investigation findings say that the person has died due to heart attack, he was a chronic alcoholic, or, he used to smoke, which has not been disclosed in the proposal form. And this is where the claim gets rejected. So this can also be an internal fraud, because if the salesperson does not disclose it in the form. The second one is non-disclosure of prior medical ailments. So, couple of examples that I have come across is there was a 48-year-old lady in rural India, some part of rural India, and she was pregnant. Now, when the salesperson went, she wanted to buy a policy when she was 4 months pregnant. So when the salesperson went to meet her, she was sitting in one place, and there is a question in the proposal form which says, "Are you pregnant?" And she said no. And after 9 months during her labor, she passed away. And when the investigation happened, they realized that, she died due to pregnancy complications and in her labor time. She was 49 years old. Anyways, it's high risk to be pregnant at that age. Had she disclosed it, probably the insurance company would not have issued the policy. So this was one of the ailments that we came across. When we asked the salesperson, he said that she was sitting in one place and I could not make out that she is pregnant. So the next category was, where the agent goes to meet one of the customers. He's sitting in his office and he was constantly sitting. He didn't get up from his seat and he didn't disclose that he has lost both his legs in an accident. And the policy gets issued as a standard life. Subsequently, when person dies after 3-4 years, it's realized that he had actually lost both his legs before the policy issuance date and the claim was rejected. So these are non-disclosures of material facts. The third one is forgery or alteration in documents, signature forgery or check forgery. Forgery is industry agnostic. It can happen anywhere and everywhere. So life insurance industry is no exception. Here I have some sample documents that I can show you all which are forged. Okay. The first one is a fake death certificate, as can be seen. This is one of the articles which has come in one of the newspapers also. So this lady, she submitted a fake death certificate. What she did was, this was a genuine DC number, death certificate number. She just forged the name and she was actually alive. She forged critical details in this and submitted this. It was investigated and later on found that this is forged. These days, death certificates are also validated on the websites, and we've come across instances where the websites also are fabricated. So insurance companies have to be on a very high alert to see where they are going in validating the death certificates, whether those websites are the genuine ones or fraudulent ones. The second example over here is of a forged check, so which I've highlighted in the red box. So this check actually belongs to someone else, but the name has been forged. The third example, as can be seen here, the account number ending is 292627. So the account number is the same. It's from the same bank, but it belongs to two different people. So someone has gone and tampered the check, changed the name, and then submitted it for policy payment or, along with the claim intimation form. So check forgery is prevalent. The third one is on income proofs, because with the insurance policy, person has to submit his or her level of income, because depending upon the income, the policy is given. So this is one of the bank balance certificates which a person had submitted. It has account codes which are mentioned and it has credits. Now, what was found out later on was that these account numbers which he has mentioned, which the customer is Camilla, these account numbers which are mentioned here on the left actually belong to somebody else. For example, 22321 account number belongs to Atif Sheikh. Then 22343 belongs to Rajesh. So somebody has tried to create a completely bank statement and give it on customer's behalf. Potentially the customer did not have income proof to show. This is a surrogate income proof, a fixed deposit, and this has been forged and submitted to the company. The next example is, this is a lady who had bought a policy. So she submitted her KYC documents, and one of the document was a PAN card that she submitted because the premium was about 50,000. With this document, she submitted fixed deposit as an evidence of income. Here, the PAN number which is mentioned is different. So the customer is Chumki Ghosh, and this is a PAN number. And the PAN number which is mentioned on the fixed deposit receipt is something else. So even before the policy was issued at the underwriting stage itself, the underwriters realized that this document is forged and the proposal was rejected. So these are some of the examples of forgery, and the key takeaways for us as chartered accountants is to see whenever we are reviewing the documents, have that line of sight or be that detailed enough to see documents in detail, and very often you can make out fabricated documents. Suddenly the font will be different, or the signature of the customer will be very different from the previous one, or will just be stuck somewhere. So for example, this, when we were reviewing many of the transactions, so this account number, you can, if you call for a dump of the bank account numbers, so all the bank account numbers were available, and then we saw, okay, it belongs to two different people. And then we called for the scanned copies of the checks, and this is how it was realized that these are all tampered. So eye for detail is required. Forgery is prevalent everywhere. And if we have that knack or we develop it, we can also detect, everyone can detect forged documents. The next one is on misrepresentation of material facts to the insurance company on the proposal date. So misrepresentation of material facts is, for example, it can be age, it can be an on occupation, or it can be income. So, person, if there is a product which the company wants to offer only to people in the age group of 18 to 55, and the person is 60 years of age or 65, and he misrepresents his age, he mentions it as 55, submits a forged age proof. So it is a misrepresentation of material fact. Had this been disclosed, then the person is not eligible for a policy. The second one is on occupation. So some people are in hazardous occupations. For example, if you are working in a mine or on a construction site, then it's more hazard. It's more prone to, it's a hazardous occupation as compared to, someone who's having a desk job. So occupation details are very important, and they need to be correctly disclosed, because, the premium for a person who is working in a mining company could differ from premium of a person who is having a corporate job, or a premium of an agriculturalist could differ. So occupation is very important to disclose. And the last one is on income. So for example, term plans, if a person is earning 2 lakhs or 3 lakh rupees, he can't get a cover for 1 crore. Because what will happen, it's not good for him only. There will be fraudsters. They will just see, okay, this is a construction worker. Okay, let me do one thing. I'll take his KYC documents and pay some premium. Then, I will only push him out from the building so that he falls down, and then I can claim 1 crore, on his life. So income, that is why is important, because there is a moral hazard. So the income has to be seen, and in line with the income, the insurance can be given. The next category is impersonation, which also happens because life insurance is insuring human beings, and impersonation is another risk that happens. One example which I'm going to take is on the video verification call. Today, with this increased digitization, a lot of verification happens on the video. We are also here on the video and not having an in-person meeting. Similarly, instead of meeting the customer in person, sometimes, they will do, insurance companies will have a video pre-issuance verification call to check, and where they will check that the person who is on the proposal form, the photo on the proposal form and the photo on the KYC documents is matching to the photo, or is matching to the person who is actually attending the call. Also on the call, they'll try to gauge his age. If he is mentioned he's 40, is he looking 40 or is he looking 60? How does he look? Does he look healthy or does he look very feeble? So this is one of the case that we had come across. It's a child policy that was taken, And this is the photo which was on the proposal form. And the person the child who attended the video PIVC was somebody different, because this child who was there on the proposal form had left the country. So this is an impersonation that had happened. So impersonation also could happen. So it is very important. Often in video PIVC, what happens is that this work is outsourced to agencies who do the video PIVC, and after they do it, they give a report that they have verified everything and everything is perfect. At least the underwriting team or whoever is issuing the policy should select sample videos and see whether the agency has done the right work or no. So this was missed out because this was not seen by the underwriters, and they just relied on the agency, and the agency gave a report that everything is okay. The second case study is on impersonation, which has happened. These are some of the rural customers. So the person's brother had passed away, and the person's brother had passed away, and the photo of somebody else was taken. So the life assured had passed away, and the life assured's nephew's photo was taken. It was a newly opened bank account. So this is a person wall mounted photo. This is a person who had actually died, and instead of him, the policy was taken for his nephew, and he misrepresented himself as this person. He took the policy, and an early claim was reported. The investigation, it was realized that the investigator found out on the field that the person for whom the policy is taken had actually died 2-3 years ago. The bank account was very recently opened. Premium was paid. The Aadhaar was forged, and this is how the deceased person was impersonated, and his own relative had taken a policy, and that person is alive. Any questions so far? If anybody has anything, I'm happy to address. Maybe you all can put it in the chat box. Coming to the next category is on funds misappropriation. Funds misappropriation, like forgery, can happen in any industry. Wherever there is cash, wherever there is money, people will find ways and means to misappropriate funds. And this is where the third component of the fraud triangle plays an important role on how robust and how strong our internal controls are over financial reporting, how robust are our financial controls. The last section of my presentation is on fraud mitigation measures. I have limited it to the case studies that I have elaborated in the previous slides. So in life insurance, some of the measures could be, to do a good sourcing of policy and not to just compromise or rely on what individuals are saying, but actually go out there and meet the customer. If it is a video PIVC or a PIVC, ensure that the person whom your salesperson is talking to is genuinely the life assured. Disclose all the related questions and give true and correct information in the proposal form. If information is asked, if there is information, have you suffered from anything in the last 3 years or something, it is expected that the person will give true and correct information. Always enter correct contact details, because mobile number is something which is key and it is used widely for OTP authentication. So when any customer receives his or her policy document, it is important. We all also will buy insurance policies. When we receive a policy document, the policy document has a copy of the proposal form to check whether the proposal form is correctly filled, whether the contact number is belonging to you only and not to anybody else, and all the details are correctly disclosed, because insurance companies are willing to pay genuine claims if things are correctly disclosed. Photocopy of the original documents of the photocopy of customers' documents should be verified with the original. That is why the original seen and verified is important, and to see that scrutinize the documents thoroughly. Death certificates have to be authenticated on valid government websites and not just on random links which are attached on the investigation reports. Video PIVC recordings have to be heard clearly. The PIVC calls have to be heard clearly, and so on. So in case if you all have any questions, I'm happy to answer because I'm almost done with my presentation.
I don't think so. There is any question in the chat box.
And is there any other topic that people would want to know? I'm happy to address that as well in the future.
There are no questions.
Okay.
Yeah, in the admin panel also there are no questions.
Right. So then over to you, Mayuri and Hema.
Yeah. Thank you so much. And on behalf of Women and Young Members Excellent Committee of ICI, it's my privilege to propose a heartfelt thanks to Ma'am CA Hina Bhagchandani Ma'am. And thank you for sparing your invaluable time for us to grace this webinar and also enlightening us on the rare and very interesting topic of frauds in life insurance industry. I am running out of words to express my humble thanks to CA Hina Bhagchandani Ma'am, and a very hearty note of thanks to all the listeners for their presence. And I would also like to extend a special thanks to our chairman and vice chairman of WYMEC committee, CA Preeti Salva ma'am and CA Abhay Chajer sir. Thank you for providing me this opportunity to moderate this webinar. And I think there are some questions. I'm just taking it. Yeah. So there's a question from Abhishek Bhajoria from Faridabad. Do insurance company conduct any fraud investigation or something? They're asking or something. Do insurance company conduct any fraud investigation?
Yes, insurance companies do conduct fraud investigation through specialized agencies, through their own teams, because it is unfair, right, to pay a fraudulent claim. It is unfair to the genuine customers. If we do not investigate and we pay the fraudsters, then we are being unfair to people who are, the genuine customers. So investigation happens. There are in-house teams, and are very big teams are there. I mean, be it in underwriting function itself, in claims. Then there are investigators sitting in internal audit functions. There are field investigators, there are forensic investigators. So it's a big space in itself to be in.
Okay. There's another question from CA Bhakti Oswal from Pune. Have you encountered some frauds personally?
Yes, I have encountered many frauds. So I have just given a few examples of, frauds here. I've encountered and I have investigated, I think, close to 1,200 to 1,400 frauds in the last few years.
Okay. Okay, there's one more question from Abhishek Bijoria. The same question. He has repeated the same question. Okay, so there are only two questions. Thank you so much, ma'am. Thank you for your time.
Yeah, thanks to you too. And thank you, everyone. Thanks for the questions. Thank you. Yeah.
Now, please, Meghna. I think the next session is pending. Yes. I think there is an instruction
Yes.
of introduction of Bijal Bhanushali ma'am.
Yeah.
Okay, I think CA Meghna would be doing that. Sorry.
I have to do that.
Okay.
Good evening, friends. Here I am to introduce Mrs. C.A. Vijay Banushali. Vijay Banushali, a chartered accountant and a member of ICAI since 2015, currently serves as Direct Tax Manager at RCJ and Associates LLP, chartered accountants in Mumbai. With more than 7 years of experience in direct tax, she has distinguished herself through specialization in the areas of charitable trust and corporate taxation, demonstrating her experience in these domains. She is also pursuing company secretary course from ICSI and has cleared a foundation and executive level. In addition to her professional qualifications, she has a profound love for painting and deep appreciation for meditation. So please enlighten us with your knowledge. Thank you, ma'am.
Thank you, Amrit. Hello, everyone. Today we'll be talking about charitable trusts and taxes. Think of the organizations who are doing selflessly, who are helping their all the organizations selflessly. Just a second, I'll share the PPT. Okay, so think of these organizations who are working selflessly for the needy and how these taxes are having an impact on these kind of charitable trusts. So together we'll now learn how the charitable trusts and the taxes are working hand in hand. In during this presentation, wherever I talk about charitable trust, it shall include and mean charitable trust, public trusts, trusts registered under the Section 8 companies, societies formed and registered under Societies Registration Act 1860. So the exemption that is available for charitable trusts is for a charitable purpose. So in order to understand the exemption, we'll have to understand the meaning of charitable purpose. Charitable purpose includes the following 7 purposes: relief of the poor, education, yoga, medical relief, preservation of environment, preservation of monuments or places or objects of artistic or historic interest, and the advancement of any other object of general public utility. So the crux here is selflessness. In order to be a charitable purpose, the purpose that you're taking into consideration has to be towards the society or a community at large and not towards a particular person, individual person. For the advancement of any other object of general public utility, there's a limitation. Like in case you are carrying out any activity in the nature of trade, commerce, or business, it will not be treated as an advancement of any other object of general public utility. There's a limitation of 20% of the receipts from trade, commerce, or business. It's like suppose if the receipts from a particular trade, business, or commerce is up to 20% of the total receipts, then the trust will be liable. Trust will be eligible for the exemption. In case not, the trust will not be eligible for the exemption. As per CBDT, there is no particular requirement to get the registration cancelled. It's just that the trust will lose the exemption for that particular assessment year. So with this, we understand the first 6 objects, the purposes that are there. The trust is free to conduct like the business with along with these 6 objects, the bar is only and only for the 7th object. So does it mean that a charitable organization cannot carry on a business? The answer is no. There is no prohibition on a charitable trust as such to carry on a business. It's just that the business has to be incidental to the attainment of the objects of the trust, and separate books of accounts have to be made. For example, we say Tirupati Balaji Trust. So they do sell laddus also, but that is a type of business they are doing incidental to the attainment of the object, that is a religious object. So it is allowed. Then so the businesses are also allowed the exemption under section 11 and section 11 and 1023C, section 12, provided the conditions mentioned in section 11-12 are met. The charitable trust can freely undertake this business activity, but the separation of books of accounts is important. It has to be looked into. In case during an assessment, the AO comes to know of any concealed income in the books of the trust, like they have not offered for tax or something, the AO will consider that concealed income as not from the religious or charitable income, but it will be a part of, the exemption for that particular income will not be allowed. It will be treated as non-charitable income. So it is very important that the maintenance of books is separate for charitable activity as well as for the business. Okay. So now we'll be understanding about the exemption under section 11. What income is exempt under section 11? Number 1, corpus donations. So corpus donation, what do you mean by corpus donation? Corpus donations are donations that the trust receives for a particular object. Like the donee clearly gives an instruction to the trust for what purpose that fund has to be utilized. So the trustees or the trust do not have any discretion in deciding for what purpose this donation will be used. There is an amendment in last Finance Act, that is Finance Budget 22, that the corpus donation will have to be compulsorily invested in the more specified under section 11.5. 11.5 reference is given in a lot of sections. We'll be talking about it later. But it is important to note that unless you do not invest these corpus donations in the more specified in 11.5, the corpus donation will not be exempt from the income. There is no particular time limit mentioned for keeping this amount like for making this investment, but we have to presume that such investments should be made before the end of the financial year. And suppose if you are withdrawing any funds from the corpus, it will not be treated as an application unless you put back the funds, deposit back the funds in the corpus, and only then it will be treated as an application of income. Then we come to 15% of gross income. So whatever is your gross receipts, 15% of that income will be treated as exempt income. It is like a standard deduction. No declaration or form has to be filed for keeping aside of these 15% of gross income. Then the exemption is for the balance amount that you utilize out of the balance 85%. So the remaining 85%, whatever you utilize, will be exempt. What is now? We'll have to understand what is application of income. Like I said, 85% like the balance 85% has to be applied for claiming exemption. So what is application of income? Application can be both capital as well as revenue expenditure, unless the expenditure that is being incurred is for the object of the trust. So there is no bar, as in purchase of fixed assets is also an application of income. Establishment expenses, payment of taxes, All such kind of revenue expenses are also allowed as application of income. Donation to other trust registered under section 12AA or 12AB, the new section. So anything, any trust registered under this act is also eligible for application of income. There's an exception to this explanation that if any donation is made towards the corpus of the trust, the other trust, that will not be allowed as application of income. Then we have repayment of loan taken for acquisition of assets. So in case you have acquired an asset, so it is out of the loan funds. So when you're making the payment, acquiring the assets, it will not be treated as an application because it is out of loan funds. But whenever you repay back that loan, that will be treated as an application of income. Now, let's say, suppose this 85% that you had to utilize for the purpose of exemption is not treated as, has not been applied by you in the current year. Then it can be treated as deemed application in two cases. Like there could be two reasons because of which you couldn't apply the 85%. Let's say if the trust has received the income in the later part of the year, towards the end of the year. So obviously, if you suppose you receive the funds in on 30th of March, 31st of March, you will not be able to spend it immediately. So what the trust can do, they can file a declaration with the AO saying that we have received this income on so and so date, so we are unable to utilize this funds, and we'll be applying it in the next year. So that will be treated as a deemed application. And there's one more case, like the application could not be done because of one more reason. Suppose the trust is maintaining its books of accounts on accrual basis. The receipts, the receipt actually might have been not received in that particular financial year. It is received in the next financial year. So again, you can treat that accrued income as deemed application. Now, let's suppose if this 85% is not applied for both the reasons that I earlier mentioned, you will have to file a declaration with the AO in form 9A, the due date of which was 30th of September prior to assessment year 23-24. But now, please note that the due date has become 31st of August. It has to be done 2 months prior to filing of return of income. So this is a big amendment for assessment year 23-24. Moving on, for trusts, provisions of section 40A1A, 40A3 and 40A3A will apply. It means that the trust cannot, if a trust has not deducted TDS on a particular income on which it was liable to deduct TDS, the 30% of that particular expense will not be allowed as an application. It will be allowed as an application in the year in which the trust has deducted and paid the TDS amount. 40A3 and 3A, the trust is not allowed the expense of more than rupees 10,000 paid in cash if as per 40A, 40A3 and 40A3A. Next, moving on, in the budget 22, the government has notified section 80G2B, wherein there's a list of religious trusts, mosques, temples and all, wherein they have an option to treat the voluntary donation as a corpus donation. If the donation was received to them for the purpose of repairs or renovation purpose, okay, and that amount has to be particularly used for the purpose of the repair and renovation work only. It has to be deposited in the 11.5 mode, safe investment mode. It cannot be donated to any other trust. And also the trusts should solely use it for the purpose for which it was received. If there was any excess application during the year. So if there's any deficit, it cannot be set off or carry forward. And the application will be purely when the actual sum is paid. So if there is any sum payable, it will not be treated as applied unless the sum is actually paid. Now coming to section 11.2, suppose you are accumulating some funds for a specific purpose. You could not apply the 85% amount and you are accumulating it for a specific purpose. Then again, you'll have to furnish a statement to the AO stating the purpose and the period for which the income is accumulated. The period here can be maximum up to 5 years. There's no limit, like you can even accumulate it for 3 years. But that amount that you're accumulating will have to be deposited in section 11.5 more. And that amount cannot be donated to any other trust. So suppose in our case, say if you are accumulating it for 3 years, you will have to utilize that fund within 3 years. In case it is not utilized in the 3 years, it will be treated as your income in the third year itself. So in the fourth assessment year, you will have to offer that income for tax. Here, the maximum period being 5th year, there's an amendment wherein now you'll have to offer the income for tax in the 5th year itself. Previously, it was in the 6th year, but now it is 5th year. So this exemption will be denied to the trust if the trust does not furnish a statement to the AO before 2 months. Like I said in the accumulation, the funds where you could not use 85%, you had to file Form 9A. Here you have to file Form 10. This also has to be furnished 2 months prior to the due date of filing of return of income, that is 31st of August. So if this form is not furnished, and also if your return of income is not furnished on or before the due date, you will not get this exemption. The exemption will be withdrawn if it has been applied to purposes other than purpose for which it was accumulated, it ceases to remain invested in 11.5 modes, or it is not utilized till the 5th year, then it will be taxable. And if it is donated to any other trust, then too it will be taxable. It will be taxable under section 115 BBI at the rate of 30%. This is again an amendment. This is a newly inserted section from assessment year 23-24. So we'll have to keep a track on this. So I have illustrated a few modes, the specified modes of investment. It is only an illustrative list. You can go through the same. There are a lot of other modes specified as well in this section. A few illustrations are investments in government savings certificates and other securities or certificates issued by the central government under the savings scheme, deposits with post office savings bank account, investment or deposit in any public sector company, investment in immovable property, deposits with IDBI. Then you have deposits with UTI. Then you have deposits with scheduled banks. All these are specific modes of investment. We call it safe investments. Then we come to section 11.6, depreciation. So suppose an assessee has claimed the purchase of a fixed asset as an application in a particular year. Then the depreciation on that particular asset will not be treated as an application in the remaining years. Then the exemption under section 10 will not be available if the trust claims an exemption under section 11, except the section 10.1, except exemption under section 10.1, 10.23C, and 10.46. 10.1 talks about exemption for agricultural income. 10.23C is for hospitals and educational institutions. And 10.46 talks about government trusts. Section 11.1, capital gains. So where any capital asset is transferred by a trust and the net consideration is utilized for the purpose of acquisition of another capital asset, then the capital gain shall be exempt as follows. So suppose if the net consideration is fully utilized, the capital gain will be fully exempt. If the net consideration is utilized partly, then the only that portion of the asset will be exempt which exceeds the cost of the new asset. So like cost of new asset minus cost of old asset shall be exempt. In case if your cost of new asset is less than the cost of old asset, the same shall not be exempt. You will not get exemption on capital gains. The capital gains provisions shall apply same for the trusts like the other persons. The tax rates for the trusts will be same as for individuals. Then we come to section 13. I'd say that there is no minimum holding period for which this new asset will have to be held. Okay. Coming to section 13.1, exemptions under section 11 shall not apply to these trusts or this for this purposes. Income from private religious trust will not be eligible for the exemption. Income for the benefit of a particular religious community will not be eligible for exemption. Income for benefit of specified persons or relatives will not be eligible. And funds not invested in 11.5, the safe investment will not be eligible. So, but there's an like income for benefit of specified persons. There is an exception that if suppose the benefit is towards the health, like for hospitals and all. So there is an exception if the health service is provided to a relative, the exemption will not be available only for that particular income. The exemption for whole of the trust will not be lost. What are the conditions that are applicable for section 11 and 12? Section 11 and 12 will be applicable, like the trust will have to get registered. Registration under section 12AB from with effect from 1st April 21. Prior it was 12AA. So the trust will have to get itself registered with the permission of principal commissioner. It has to maintain proper books of accounts and the other documents. It has to be compulsorily audited if its income is exceeding the basic exemption criteria, that is 250,000. The same has to be, the audit report has to be filed in form 10B or 10BB. The form has changed recently with a wider notification that was issued in February 2023. So we have a new form this year for filing the audit report. Then the application for registration due to change of objects. So if there is a change in object of the trust, again you will have to file a application for fresh registration because the object in itself has changed. So it is important for the principal commissioner to know if the object has changed. Only then he will continue to grant the exemption to you. Then the return of income has to be filed in time, like that is before 30th of September for claiming exemption under section 11 and 12. Now, what is anonymous donations? Anonymous donations are donations that you receive without, disclosing the identity. Like in Mandir and all, you put funds in the peti, dan peti. So that is anonymous donation. You do not know who has put the funds and all. So that is anonymous donation. For charitable organizations, charitable trusts, there is a limit of 5% of the total donations or 1 lakh, like whichever is higher, that will be allowed as anonymous donation. Over and above this limit, the anonymous donations will be charged at the rate of 30%. The suppose, for example, the income that the anonymous donations that you're receiving is within these limits, the tax rate applicable for this limited donation will be as per slab rate, like the normal tax rate. But for the amount over and above this limit will be 30%. Coming to section 115 BBI, this is a new amendment that has come from the last budget. So the following incomes will be taxable at the rate of 30%. The incomes accumulated or set apart in excess of 15%, where such accumulation is not allowed under any specific provision. So where the amount could not be utilized, like the 85% that you had set apart by filing Form 9A or Form 10, and you could not utilize within 3 years, within 5 years, or within the next year on receipt of the income, then it will become taxable at the rate of 30%. The deemed income under section 11.1, it is again the income that you received but could not, you have received during the end of the previous year, but could not be utilized because of lack of time. Again, that will be treated as, again, it will be taxable at 30% because you could not utilize it in the next year as well. The deemed income as per section 11.3, again, it is the one wherein you could not spend the funds out of the 85% that was accumulated for a particular purpose. It will be treated as, it will be taxed at 30%. Income applied for the benefit of specified person as per section 13.1. So if you are applying it for the benefit of specified persons such as your relatives, then a donee who is donating for more than 50,000 rupees in your trust. So again, the exemption, like the exemption 2 for that particular person is lost, income from that particular person is lost, and it will be taxable at the rate of 30%. If your income is not invested or deposited in the mode specified under 11.5, it will be taxable at 30%. And if the income is used for any purpose outside India, then again, it will be taxable at the rate of 30%. So we'll look here where we have, I have tried to jot down, like, how will the computation of a charitable trust look like? We have gross receipts wherein the corpus and anonymous donations are excluded at first. Then we have capital gain on transfer of the asset. By adding both these, after adding both of these, we'll reduce the standard deduction of 15% that I was talking about in section 11.1. Then the amount that is applied out of the 85% remaining, that applied portion will be reduced. The capital gain that is deemed to be applied under section 11.1A, that is the cost of new asset minus cost of old asset that was utilized. So here we reduce that. The deemed application amount out of that 85% that we had accumulated, and the income accumulated under section 11 will again have to be reduced. That is the amount we had kept aside for a specific purpose and could not be used within the period of 5 years. That will have to be reduced. So after reducing all these incomes, we'll come to an income which will be charged at normal tax rates. Then we add anonymous donations, which will be chargeable at the rate of 30%. That is the income over and above 1 lakh or 5% of your total donations. Then the incomes taxable under section 115 BBI at the rate of 30%. We just saw what incomes are taxable at 115 BBI. And then we derive at the total income. Now, talking about section 115 TD, tax on accredited income. This is a very, very important amendment that had come last year. What do we mean by accredited income? Accredited income is the income. It is this is a tax that is being charged to a trust on meeting of these 3 criteria, like where a trust has converted or merged, conversion of a trust or institution, or where the trust has merged into any other entity with not so similar objects, and non-distribution of assets on dissolution to any other trust or institution. So the levy will be at MMR, that is 30 plus 12% of surcharge, 30% plus 12% of surcharge plus 4% cess, that is at 34.944%. The conversion of trust or institution means a trust or institution will be deemed to be converted into any form not eligible for registration under 12AA in a previous year if the registration granted to it earlier was cancelled due to some reason, or it has modified its object and it has not applied for a fresh registration. The merger of an entity into of the trust into an entity without having similar objects will again be liable to pay exit tax. Okay, this is prominently known as exit tax. And the non-distribution, the trust that is going for a dissolution is liable to distribute its assets within a period of 12 months from the date of dissolution. If the trust does not go for the distribution within this period of 12 months, it will be liable to tax on accredited income. Okay, so here, just last week, we had a notification wherein the trust who could not be re-registered before 31st of March 21, they had an extended period till 30th June 21, and then again 31st March 22, which was last extended to 25th of November 2022. The CBDT has again come up with an extension up till 30th of September 23. So you still have time for your clients who have not renewed their registration under 12AB. You can still go and get these trusts registered and save them from exit tax. In case the re-registration is not done, it will be deemed to be converted. And tax on accredited income will be liable. So what is accredited income? Accredited income will be aggregate FMV of total assets reduced by total liabilities of the assets. What assets shall not be considered in accredited income? The assets that are acquired from agriculture income. So it is very logical to understand that if you have acquired an asset from an exempt income, it will obviously not be included in your accredited income. Then any asset that you've acquired before registration under 12AA or 12AB, that will also not be included in your aggregate assets, FMV of total assets, because you have not claimed that particular asset as an application. So it is right to say that it should not be included in the total FMV of your total assets. Then the asset transferred after dissolution within 12 months. So as I earlier said that the trusts who are going for dissolution will have to transfer their assets within a period of 12 months. So if they are transferring it within the 12 months, that particular asset will not be included in the total assets. Then coming to section 115 TD, exit tax is payable even if no income tax is payable by the trust or the institution. So let's say if the trust says mera koi liability nahi tha under this particular because of so and so exemption, still it will have to pay exit tax. What is the time limit within which this exit tax is to be paid? The time limit is 14 days. 14 days will start from when? So if suppose in case of the conversion, it will be from the date of conversion, 14th day from the date of conversion. If suppose you have, if the registration has been cancelled and the assessee trust opts for an appeal with ITAT, because this registration is with principal commissioner, so the case has to go to ITAT. It has to file an appeal with the ITAT within 60 days. If suppose the appeal has not been filed with 60 days, on the expiry of 60 days, 14 days from that end of 60 days will be counted the period during which the exit tax has to be paid. Suppose the appeal has been filed and rejected by the ITAT. Like if the ITAT has rejected your application to get the trust registered, 14 days from the day of your cancellation, like the rejection order, will be the period during which you will have to pay the interest, will have to pay the exit tax. What if you do not pay the exit tax in time? Interest at the rate of 1% per month or part of the month from the 15th day till the date on which tax is paid will be leviable. So a trust has to make the payment within 14 days itself. And also, the assessee will be deemed to be an assessee in default. Here, I would say that I'm not talked about the trusts that are registered under Section 1023C. So 1023C, we have got three types of trusts. Number one, where there are registered, hospitals or educational institutions with more than 50% of stake of the government. They do not have to go for registration per se, like we have to get registered under 12AB, and also they do not have to go for registration under Section 1023C. It is like an automatic exemption that they get. Then we have trusts, the smaller trusts with income less than 5 crores. They with the object of education and health. So again, for those trusts also, registration is not required. They can go for claiming the exemption under 1023C without registration. Then we have the third type, wherein the trusts have the income of more than 5 crores. There the trusts will have to be compulsorily registered under Section 1023C if they want to claim exemption. The application will have to be made to Principal Commissioner, like in 12, like we do in 12AB. So the amendments that have come last year have been brought more or less to bring 1023C and Section 12AB at par. We call that 12AB and 1023C as the old regime and the new regime. So all these amendments were brought only and only to align both of these regimes. I have covered like almost all the amendments that will be applicable for this particular assessment year. In trusts lately, a lot of amendments have come which are not covered in this. My target was only to be like, for this particular season, I have covered like whatever will be applicable. So in case if anybody has any doubts with regards to what I have presented today, please share your questions.
Thank you, Bijal, for having this wonderful session. I will just take up a few questions which have been seen on the screen from the members. So one of the question is whether can I file a condonation for delay under 1192B if I have not spent the amount within 5 years?
Yes, there is an option for condonation of delay, but that condonation is only if you have filed it at a later. Like suppose if you have not filed, only what are you going to ask for? Like condonation of what? So only if you have filed belated, then you can file a condonation.
Okay. Next question is, say if a tenant has undergone some renovation work without the permission of the trust, in case of a trust property, then when the trust came to know about the same, they had asked for certain compensation. So how would this compensation be treated as an income in the trust's books?
The compensation can be very well like included in your income, because it is obviously from the the property held under trust. If that particular immovable property was held under trust, So you can claim that as an income, and the expenses of application can be shown against that particular income.
Okay. The next question is, there is a temple running under inspection of a saint, and the people give donation to the temple as well as the saint who manages the temple. So
Okay.
how should this be considered from taxation perspective? I mean, do we separate the amount of donation given to the saint as his personal amount, or shall it be
Yes.
clubbed within the
No, that will
temple?
have to be separately like taxable. It cannot be clubbed with the trusts.
Okay. One last question. If a charitable trust claims exemption on rental income, when any such, I mean, for an event, there is a, say, property hired, okay, by the charitable trust, and in that property, the rental income, okay, trust takes rent for that particular event. So
Okay.
how would that be considered in the books of charitable trust? Can
It
the
will.
trust claim such an exemption on such rental incomes?
Yes, the trust can claim exemption on this income, though it is, because if it is in alignment with your objects of the trust, then it can very well claim. So, like for example, we have few religions wherein they have community halls along with their temple and all. So they do let out such halls for marriage purpose or any other such functions. So exemption is also available for that particular income, provided it is in alignment with your objects.
Okay. And how about subletting?
No, subletting, like, is it allowed particularly in your rent agreement?
Okay.
So you'll
So
have
we
to
need to consider whether it is
Yeah.
a part of our agreement, and we have formal communication over subletting,
Yeah.
right? Then we can consider it to be an exemption from
Yeah.
the income. Okay. One question, there are further questions coming in. What is the possibilities if Form 10B is accepted after 30 days from the date of filing the return?
As of now, like we had the option of condonation of delay. The exemption is lost because you have not filed Form 10B within time. But you can still go for a condonation where it may get accepted and the exemption might get allowed. So
Okay.
try with the condonation.
Okay. Next question. Do we need to pay taxes on the opening corpus fund as on 1/4/2021 if we utilized it for purchase of assets?
Yes. So corpus in itself is exempt. You cannot use that corpus for other purpose other than the object of the trust. Now, if you are, if suppose you are using the corpus, you will have to put back the funds in the corpus. Only then, like, it will be treated as an application. So if not, then you'll have to pay taxes on it.
Okay. Next question. If it pertains to the previous question where I had mentioned that donation is received by the saint and the temple separately. So there is a follow-up question. Under which head will the donation received by the saint be taxable?
It will go in his personal return as income from other sources.
Other sources, or okay. Last question. If trust sold a property for 100 lakhs, which was purchased for 80 lakh by taking a loan of 25 lakhs. Now capital gain is 20 lakhs. If trust repays the loan, whether any tax liability, no other receipt in the trust.
Okay, so we'll have to check whether the trust had treated the original cost of purchase. Like if the property was for 100 lakhs and 80 lakhs was out of loan, so only 20 lakhs could have been taken as application of income. If they had taken the whole of 100 lakhs as application, the balance amount cannot be taken as application.
Okay. That's it with the questions. I, on behalf of ICAI, thank you, Bijal, for concluding this session so beautifully and answering all the questions and solving all the doubts pertaining to the latest amendments. I, on behalf of the Women and Young Members Excellence Committee and ICAI, present you a hearty vote of thanks.
Thank you so much.
And with this, we conclude the session. I request the technical support team to close the live session.